Hello, learners. Welcome to Financing Decisions, another important lesson in the financial management and also one of the important principles of the financial management. The financing decision is one of the three core financial decisions every firm must make alongside the investment decision and dividend decision. So, what actually is a financing decision? Financing decision, it involves determining how a company will rise to fund its operations, growth strategies, and long-term investment. Whenever we talk about the financing decision, because the financing decisions involves choosing the best mix of equity and debt to fund business operations and investments. Companies can raise money by issuing the shares or borrowing through loans. Managers, as financial managers, we must balance the cost of capital with the associated risks, such as ensuring the loan repayments or maintaining the shareholder satisfaction. The right financing decision helps build a sustainable financial structure. As a financial manager, the ultimate goal should be to ensure that the company has enough resources to invest in the projects while balancing the risk and cost. Because it is a strategic choice which has to be made by a company to determine how it will raise the funds for its operations and its growth. For example, a company may choose debt financing if it has strong cash flow, as interest payments are tax deductible, making it as a cheaper option. The financing decision includes analyzing the impact of these choices on the company's financial structure, risk, and the cost of capital. The sources of finance. When it comes to the sources of finance, understanding the various sources of finance helps firms craft their financing strategies effectively. We have two categorizations. One is the internal sources and second one is the external sources. Retained earnings. Profits reinvested back into the business rather than paid out as dividends. This is the most effective form of finance as it involves no interest or ownership dilution. Say, for example, a software company like XYZ may use the retained earnings to invest in R&D, or maybe they may expand into the new markets. External sources. External sources, again, we have two categories majorly: debt financing and the equity finance. Debt financing involves borrowing the funds from external parties with an obligation to repay with the interest. It includes like bank loans or bonds, debentures, and commercial paper. Why debt? Because debt is generally cheaper than equity due to tax deductibility of interest but increases the firm's financial risk. Another category is equity finance. Raising capital by issuing shares to investors, where investors receive ownership rights and potential dividends. But equity financing is considered more expensive than debt, but it involves no repayment obligation. For example, a startup company may raise around, say, 50 crores through the venture capital firms, whereas when it comes to the debt part, a manufacturing company may raise 100 crores through a term loan from the consortium of the banks. Now, let us understand what are the various factors influencing the financing decision. Why factors? While making a financing decision, companies need to consider several factors which will impact the ability to raise funds and sustain the growth. These factors help determine the most suitable sources of finance, whether through debt or equity. The first factor, the cost of the funds. One of the primary considerations when making a financing decision is the cost of raising the funds. Different sources of finance, such as equity or debt, come with different costs. The cost of equity will be different, cost of retained earnings will be different, cost of preference capital will be different, cost of debt will be different. But in some cases, debt may be cheaper, but it comes with certain risks, like obligations we have. A company may prefer the least expensive option to minimize its financial burden while ensuring the sufficient funds for growth also. Another important factor is the risk. Because whenever we talk about the financing decision or financing option, it comes with the certain level of risk. Say when we talk about debt financing, it involves lower risk. When we talk about the equity financing, it comes with the higher risk. Debt financing with the higher risk and equity financing with the lower risk. But here, dividends are not mandatory. So there are options in front of the financial manager. There are certain options, financing options are available. And which financing option is opt for the organization, keeping the growth of the organization in the mind. For example, a startup company may prefer equity financing over debt because it does not have to worry about fixed payments in its early stages. Another important factor, floating cost. The expenses involved in issuing the new securities known as a floating cost, which will impact the choice of financing. Equity financing generally involves a lower flotation cost compared to debt finance. Companies tend to opt for the option with the lower flotation cost to ensure they raise more funds for their operations. For example, a company issuing bonds might incur high legal and underwriting fee, while issuing new shares might involve low cost, making it more attractive option though a flotation cost is considered. Cash flow position, another important aspect factor, because the strong cash flow position makes it easier for companies to take the debt because they can comfortably meet interest payments and repay the principal. For example, a company with the steady cash flow might choose debt to take advantage of low interest rates without fearing any shortfall. Control considerations. Equity financing leads to the dilution of the control among existing shareholders. Companies that are concerned about a potential takeover may avoid issuing additional equity to prevent the losing control. For example, if we observe any family-owned businesses, they may prefer debt over equity to maintain their control over the business decisions. State of the capital market. The condition of the capital market significantly affects financing decisions, because if you observe in the bullish market, when stock prices are rising, it becomes easier to raise funds through the sale of the shares, because most of the investors will be in a position to buy. But vice versa, in the bearish market, companies may find it challenging to issue the equity and they may choose debt finance. Tax considerations. Tax rates are an important factor in financing decision, since interest payments on debt are tax deductible. Companies may prefer debt financing in a high tax environment because it reduces their overall tax liability. Equity finance, unlike debt, does not offer the same tax advantage. Another factor, regulatory environment. Legal and regulatory factors also influence financing decisions. Regulations like Companies Act, SEBI guidelines may impact the ability of a company to raise the funds from the public. Financial position of the company. A company's overall financial health has a significant role in the financing decision. The companies with a solid financial position, and if they are having stable earnings, definitely they prefer debt finance. Flexibility. Financing decisions should also account for the future. If a company fully utilizes its debt potential, it may lose the flexibility to take more debt in the future. This can be especially critical if the company anticipates future financing needs. Importance. So when it comes to the importance, a financing decision is crucial because it determines how a business acquires funds, the first importance factor, if we observe, it ensures the sufficient funds. because business has enough funds to operate and invest in the growth opportunities without running into liquidity issues. Optimal capital structure, making it the right financing decision which helps balance debt and equity, reducing financial risk and minimizing the cost of it. Efficiency, when it comes to the cost efficiency, choosing the most cost effective financing option helps the businesses reduce expenses. Financing decisions provide the funds needed for business expansion, new projects, and market entry, driving the long term growth. Control and ownership. Debt financing does not dilute the control, unlike equity finance. Risk management also. When it comes to the risk management, proper financing decision helps managing the financial risk, and we can prevent over reliance on debt and maintaining the financial stability. It adapts to the market conditions. During favorable market conditions like low interest rates, or businesses can opt for debt financing to reduce and improve the profitability. So, today, summing up, we have understood the concept of financing decision. We have understood different sources of finance. We have seen factors affecting the financing decision, importance of the financing decision. To conclude, I can say that every decision has a cost. As a financial manager, we have to be sure to consider our options. Thank you.